Hey investors, and welcome back to FiscalVoyage. My name is Felix, and today's video we're going to talk about 3 dividend stocks for high total rate of return or high return. So these 3 dividend stocks are undervalued. Some of them I talked about before and one new one. If you're new to the channel, make sure to hit that subscribe button and like this video if you like to make money. And these 3 dividend stocks are potential buys and potential high returns. So let's get into this. All right, so the first dividend cheap stock we want to look at is Northrop Grumman Corporation, ticker symbol NOC. Right now it's going for $300 a share. You can see here it has a current P of only 13, which is really good for a high quality company. Dividend yield is very low at 1.91%, but it is much higher than the S&P 500 total market dividend. And another thing that I like to look at is the dividend yield in the 5-year time frame. You can see here the 4-year average is 1.52 and currently at 1.91 is a good indicator that the company is undervalued. And you can see here whenever it reached close to a PE of 2 or slightly higher than 2, it came back down to 1.3 here, 1.5, 1.6, and as low as 1.2. So this is a good indicator that the company, Northrop Grumman, is undervalued based on dividend yield. Another thing I like to look at is the Morningstar rating. And right now Morningstar gives it a 4-star out of 5 buy rating. So that's a good rating for a company from Morningstar, especially a high quality company like Northrop Grumman Corp. You can see here they provide a fair value of $338. And last closing price at $303, as you saw, is right now $300, so it's low today. So this is why I think it's a good buying opportunity for this company, high quality company. Economic moat is wide. I like to see a wide economic moat or a narrow economic moat, some kind of moat, because what this does is gives the company a competitive advantage. Other competitors are hard to take shares of the market for this market. For the military and industrial market. Some of the financial things I like to look at is debt to equity ratio. It is pretty high at 1.6, but I've seen a lot worse. And considering this is a very high intensive company where they're spending a lot of money and things, debt to equity ratio at 1.6 I'm okay with. The interest coverage is very solid at 6.07. Current ratio is decent at 1.44. So overall the financials does look good. The price to sell ratio looks outstanding at 1.45. I think a 2 price to sell ratio and lower is really attractive. Some things also, if we go to the key ratio here and look at the 10-year period, what I do is also, I grab some of these key information and put it in my rule number 1 big 5 spreadsheet here. And this spreadsheet, basically you simply highlight, for example, I highlight the revenue here and copy that and then put it in here. And I do the same thing for earnings, equity, and free cash flow. I did this already for you guys, but you can see here return on investment capital, very solid, so it beats that criteria, rule 1, which is 10% or higher for the 10-year, 5-year, and 1 year. The equity, however, is not that great. It actually fails the rule number 1 investing from Phil Town. But I give it a pass, because it's such a high quality and company that's grown so much. Earnings, the same thing, doesn't pass, but sales looks positive. 5-year at 9.5 growth and 1 year 12.4% growth, and cash very solid. And so again, you could download the spreadsheet in the description below. There's a link to download the spreadsheet, and then you could plug in your numbers for any company and to see if it matches or beats the criteria for rule number 1 investing. So let's continue with Northrop Grumman. You can see here this is a fast graph for the company. Very solid. This is a beautiful chart. I love charts like this from fast graph. When I see a company and I see the uptrend for the earnings, I really like that a lot. And now if we add the price, you can see how the company follows the price. There was a years in 2010 to 2014 where it was not following, it was undervalued, the market wasn't valuating the company accurately, and you can see for that it returned it very nicely. Even though the company was growing earnings, you can see 39%, 9%, 5%, 7%, 17%. It was growing earnings in all those years, but the market kind of had it at flat. This is when it's great time to buy shares for companies like this. When you see that the company earnings are continue to grow, but either the price is flat or kind of like a downtrend, that's when you really want to buy, and that's where you make a lot of your money, is when earnings are going up, but the price is flat and or heading down. Those are what I like to look for when I purchase company. And you can see here, we're showing this time period. You can see here, the price since the beginning of the year has been down. You see the downtrend here. And however, earnings is expected to be up 7% for the year, even with all the things that have been going on, the shutdown, COVID, and all this thing. Earnings are expected to be up 7% and then 6% for 2021. And this is why I think this presents a good buying opportunity for Northrop Grumman. You can see here, if we revert back to the mean of a PE of 16, and right now the PE is of 13, you could have a total annual rate of return of 21%. This is great annual rate of return for a company that's such a high quality company like Northrop Grumman. You can see here has a S&P credit rating of BBB, which is investment grade credit rating. Debt to cap ratio is only 55%, 5% higher than my criteria, but I give it a pass there. Earnings yield at 7.46, very attractive earnings yield. Again, the dividend yield is not that great, but it is better than the S&P 500 market yield. So overall, I like Northrop Grumman. I actually own some shares of this company. I'm slightly down, but I'm interested definitely to buy more shares, because right now I think the company presents a great buying opportunity. You can have a nice annual rate of return. Forecasting, if we look, you can see here the long-term chart for the next 3-5 years. Even if it stays at a P or 11, you can have a potential 27% annual rate of return. It's very unlikely, but it just shows you how undervalued this company is at the current market. So I think this presents a good buying opportunity. So let's go to the second solid dividend cheap stock that we could buy today. So the next company that is a dividend cheap company is Bristol-Myers Squibb, ticker symbol BMY. I actually covered this video in previous video if you subscribe to my channel. Again, if you haven't already subscribed, make sure to hit the subscribe button and like this video for the YouTube algorithm. But Bristol-Myers Squibb is still a very attractive company. This is a high quality company, very attractive yield, much better than Northrop Grumman at 2.95. But what makes this company so attractive, and I'll show you, is because right now, first let's go over Morningstar. It gives a 3-star rating out of 5, which is fairly priced. It has an economic moat of wide. Again, I like to see wide and narrow moats, so this is very positive here. But it is slightly undervalued right now at $60 versus $68 fair price. Some of the key metrics that I like here: debt to equity ratio 0.9, very solid. Interest coverage is lower than the last one at 3.57, but it beats my criteria 2.5 and higher, so I give it a pass there. Current ratio is solid, over 1.5 criteria, so that beats a pass there. But this is what I like to see here. With a fast graph, you can see here earnings are expected to be huge this year. At the end of the year, they're expected to grow earnings about 36%, next year 17%, and 2022 8%. So this is what's going to drive this company much higher. You can see you can have a potential annual rate of return of 53%. I'm fully invested in this company. I'm finished buying shares, but you can see here S&P credit rating of A+, 43% long-term debt to cap ratio. Again, 10.27% earnings yield. Very attractive company, solid company, investment grade. Make sure you do your research in this company. It's very, very attractive right now. I'm very happy with it. And if it does drop, to $48, $50, I'm gonna buy a lot more, because it's just a matter of time before this company the market really realize how undervalued this company is. So this is why I think this is the second company that you guys should look into. Bristol-Myers Squibb, ticker symbol BMY. And the third company we're going to look at right quick is Atera Group. Atera Group, actually, I've made videos of this one as well in early November. And you can see here, let's get rid of the price chart, you can see earnings have been outstanding throughout the years. Even though people are saying, people stop smoking cigarettes, there is a decline, but they continue to grow revenue, they continue to grow earnings, you can see here, and eventually price follows earnings. And one of the things, like I mentioned before, I made a video before around this time period, and you can see it's already up around 20%. Again, that's why you guys need to subscribe to my channel, because in this channel we like to make money with long-term high-quality companies. So if you can see here, if the company Atari Group revert back to its mean of a PE around 17 or 18, which I think that's very optimistic there. I think a PE around 15 is more reasonable, but you can even see that a PE around 15 with a current PE of only 9.8 gives you a total annual return of about 35.5% annually for the next few years. So that's outstanding growth. Not only that, you have the opportunity to collect an outstanding dividend yield of 8%. So it gives it a very attractive dividend yield for those investors looking for dividend income. And again, this is another company that owns a lot of shares, and I'm very happy with it. The only thing I don't like is the high long-term debt to cap at 85%. But the company is an investment grade at BBB, so it's very solid, so I'm not worried about that. But overall, this company and another company I talked about before is British Tobacco International, ticker symbol BTI. That one is actually up as well since my previous videos. So again, make sure to hit that subscribe button because we talk about high quality long-term investments. You can see here, I made a video I think around this time period, around when it was $30 a share, and now it's at $39. So about a $10 increase in share price. So again, make sure to hit the subscribe button. So those are my 3 or 4 stocks that I like right now in today's market. And again, there's a lot of overvalued stock in today's market. Like Microsoft, Apple, I find overvalued. A lot of tech stocks I find to be overvalued. And what basically overvalued means is that your risk and your potential total return for the foreseeable future is much lower. For example, if a company is overvalued, there's a much better chance that the down could be much more hurtful than if you were to buy a fairly or undervalued company, a high quality company. So this is why I like to buy undervalued, high quality company, because if it was to go down, it may go down by 10% more, and then from there, it will go up, because I've experienced that in my 7-8 years of investing. I've experienced that where I buy shares undervalued and it'll drop maybe 5 to 10%. But what I do is I add more shares, and then it'll pick up. And then I have companies where I'm up 70%, 100%. I have a few close to 200% in my portfolio. So just because a company goes down doesn't mean a bad thing. So again, that's why undervaluation, overvaluation is so important. The valuation is so important in a company that you purchase. So this is why these 3 or 4 companies that I mentioned in this video are such high quality company, and they're undervalued. And I think you guys should definitely research them and check them out. Tell me what you think in the comments. Are you interested in buying them? What undervalued company are you interested in buying right now? So again, thank you for watching. And if you're new to the channel, make sure to hit that subscribe button and like this video if you enjoyed it and made it this far. As well as check out my spreadsheet. You could get a link for it in the description. There's a link for it to download it, that spreadsheet, which is Rule Number 1 Investing from Phil Town. A great book. But download that spreadsheet and it'll help you with your analyzing of any particular company. So again, thank you for watching, and I'll see you guys in the next one.